Are we on the brink of disaster? The U.S. economy, once robust, now teeters on the edge. As we stand in 2023, questions loom. Is the U.S. economy recovering, or is the U.S. economy in deep trouble? Join us as we delve into the details of the U.S. economy in 2023. Remember the economic chaos of 2008 when the housing market crashed? Michael Burry was one of the few who saw it coming and made a fortune by predicting it. He is now back with another significant forecast. His new prediction involves a bold move where he's invested millions of dollars in betting against the NASDAQ and S&P 500 indices. What's more intriguing is that he's selling off shares in regional banks, a sign he's anticipating a financial downturn. Notably, other influential players like Warren Buffett have also entered the game, selling billions of dollars worth of stocks in preparation for what they believe is a major stock market decline. What secrets do they hold that the rest of us might not know? Let's go more in-depth in this intriguing story to find out. Burry has committed over 90% of his investment portfolio to this bold move. This kind of gamble is no small feat, and it shows that Burry is confident in his prediction. He earned his reputation by foreseeing market crashes, and his successful bets against the housing market made him and his investors rich, while others faced heavy losses. Despite his mixed statements on Twitter about future market crashes, his recent actions mirror his convictions. If you had mirrored his company's trades over the last 3 years, you would have reaped a 56% return, more than 4 times the S&P 500's returns during the same period. This time, he's taking on exchange-traded funds, ETFs, which are like financial tools that allow people to invest in multiple companies while keeping things simple. ETFs are like a basket of investments. Imagine you're at a farmer's market, and instead of buying just one type of fruit, you buy a basket containing different fruits. That's how ETFs work. They let you spread your investment across many companies, all in one go. So, if these companies do well, your investment does too. It's like a way to invest in the whole economy without picking individual companies. ETFs have become super popular in recent years because, on average, the economy tends to grow, and this helps investors make money without too much risk. But remember, there's no such thing as a completely safe bet in the world of finance. Even though investing in ETFs can be a good way to make money, it's not foolproof. If the economy takes a nosedive, things can go downhill quickly. And here's where Burry's bet comes in. He's not just betting against any ETFs. He's going after the ones that track big parts of the economy, like the S&P 500 and the NASDAQ 100. These indices are groups of big companies, like the tech giants Apple, Google, Microsoft, Amazon, Tesla, and Nvidia. These companies are so big that their combined worth is more than the rest of the companies in the index put together. If they are really such giants, why are people like Burry and Buffett predicting a decline? This is because they're seeing signs that the U.S. might be heading towards a recession. There's talk about a potential collapse of the U.S. dollar and worries about various financial bubbles popping. The S&P 500 index could potentially see a massive drop if these predictions come true. Another interesting aspect of this whole ordeal is the recent AI boom we've noticed. Experts are saying that AI and other advanced tech will be the kings of the future. This idea alone has caused the values of tech companies to shoot up. In particular, a company called Nvidia, which makes special chips that power AI, has seen its value soar by over 200% since the year began. Whenever there's such a massive rise in valuation, there's always a dip. So it's understandable that people like Burry are cautious about these sky-high values. Nvidia's chips are like the heart of AI technology, and if AI doesn't become as big as everyone hopes, these companies might take a major hit. AI companies especially rely a lot on money from investors to keep going. They often get big bags of cash from investors to develop their AI technology, and they only start making real money when their AI models become super valuable. But here's the catch. If interest rates go up, getting these big bags of cash becomes more expensive. Imagine if the price of borrowing a bike went up. It might make you think twice about borrowing one. The same goes for companies borrowing money. If it's too expensive to borrow, it gets hard to stay afloat. If the AI revolution doesn't work out as planned, it will spell disaster for these tech companies. These companies have invested tons of money based on AI becoming big and quick. So if that doesn't happen, we might end up with a lot of companies struggling for money. This is similar to what happened in the late 1990s with the dot-com bubble, where companies put all their hopes on the internet. Even if AI turns out to be everything people dream of, it doesn't mean the tech companies are safe. How? See, for these sky-high values to make sense, AI has to change everything. It needs to replace jobs and change how the economy works. This means a lot of people might lose their jobs, which can lead to a recession. When people lose their jobs, they don't have money to spend, and when no one's buying things, companies struggle, and the economy slows down. We've done a great detailed video on how AI will change the economy, which you can find in the top right corner of this video. How would all this affect the companies? The biggest AI companies could actually benefit from this AI revolution. These giants already have advanced AI, so they can replace employees with their super smart technology. They'll become super efficient and might even build a monopoly on AI. Big tech companies like Microsoft, Meta, and Google might become even more powerful during the next recession. However, the smaller AI companies might struggle or even shut down. This could make the tech world even more unbalanced, causing problems for stock market indices like the Nasdaq 100. Now, let's dive into another critical aspect of our economy, the housing market. It's a big deal, especially for young people and those looking to buy their first home. If you've heard people talk about how expensive homes are, they're not kidding. The cost of homes has gone up way faster than people's paychecks. If we look at the money households make and compare it to how much houses cost, it's not a good picture. Back in 2006, during another time when housing was really expensive, houses cost about 7 times the average household income. But now, it's even worse, nearing 8 times the income on average. In places like New York, it's around 10 times the average income. And in Los Angeles, it's a jaw-dropping 13 times. But here's the kicker. A big part of the problem comes from companies being greedy and using houses as tools for making money. In some places, companies like BlackRock and Vanguard are buying up homes like crazy. These are giant corporations, and they're becoming some of the biggest homeowners in the country. In places like Charlotte and Atlanta, over 30% of the homes sold in 2021 went to these big investors. This isn't just happening in a few places. Across the nation, nearly 18% of homes sold were snapped up by these investor giants. This trend is worrying because at the rate things are going, by 2030, more than 40% of all single-family homes could be owned by these big corporations. This housing situation isn't great for families. Imagine you're trying to buy a home in your neighborhood, but a big company from far away outbids you. They're like the big kid who takes your lunch money. It's frustrating. And it's not just about the homes, it's about families. These corporations often turn houses into rentals, which means fewer families can actually own their homes. This isn't good for anyone, and it could lead to more economic troubles. Now, let's look at the bigger picture. We're not just dealing with housing and economic issues. There are global shifts happening too. Conflicts like the ongoing war in Ukraine and tensions between countries like China and Taiwan are adding more uncertainty to the mix. This adds to the already complicated situation. The takeaway here is that we're entering a period of change, a transition in history. The way power is distributed around the world is shifting, and with conflicts and global tensions on the rise, it's hard to believe that the stock market's recent positive turn will be enough to handle the changes ahead. All this makes Michael Burry's predictions and Warren Buffett's moves carry some weight. If you want to learn more about the upcoming recession, click the video on screen now, where we discuss why Americans have stopped spending and go more in depth about the 2023 recession.